Welcome back. This week, we're going to talk about what happens to stock markets after the Fed pauses, after they stop hiking rates. One of the things to know is that they don't necessarily go from pausing to reversing, i.e., a rate cutting cycle. So that's worth knowing. But we're not going to touch on that part too much. The way I'd like to introduce this is as TXMC says, if you believe that a recession is likely, then to claim the bottom is in, you must be articulating a belief that this time will be wholly different from all prior recessionary bear markets, and you need to show receipts. History favors the other side, in which it does, and the way he defines a recessionary bear market is more than a 20% drop. Now, the charts we're going to look at don't use that qualifier. They just review rate hiking cycles in general. So I hear a lot of talk about how people both think that the October low is the quote unquote official low, but they also think that a recession is coming. And that information contradicts itself statistically from prior examples. But of course, they're just running their mouth and they don't really know what they're talking about, and they're just subjective emotionalists running around without much of evidence to back it up. And they might pull a couple of post hoc rationalizations out, but that's all it is it's merely confirmation bias. And you see charts like this floating around. This one is from Goldman Sachs, Global Investment Research. And what they've done is they've come through and they've cherry-picked some more spectacular examples of what the stock market does, the S&P 500, as I'm colloquially calling the stock market. I'm well aware it entails more than the S&P 500. And they're demonstrating that 5 out of 6 times from their cherry-picked data set, because remember, they could have done the opposite and fair-mongered you that way instead of hyping you up this way, but they didn't. And they demonstrate that the market, on average, because they have an average, goes up, we'll just call that 15%. And then you see other pieces similar to that, like this one, that talks about hiking cycles, number of months of the hiking cycle, what happened during the hiking cycle, and then 6 months and 12 months after the Fed pauses. And they all show, on average, a positive return, and a decent return at that. Now, let me show you a more real chart. And by real, I mean one that actually factors in a more reasonable data set and sets more of a historical precedent. But it's not a sexy looking, so people don't like it. And what you'll see here is in this vertical line is number 0 on the x-axis. 0 is that's when they stop hiking rates. And what you'll see is you'll see 3 dates to the left and 10 dates to the right. And those 10 dates to the right are the market bottoms that happen after the pause. And the 3 to the left are market bottoms that happened before the pause. So if we think that the October low was the low in the market, then we think we are on the left-hand column and not the right-hand column. And then the question becomes, why do you think that? Because that's what critical thought is examining your presuppositions, questioning the concepts in your statements as much as the statements themselves, keeping constant your comparisons and controlling for variables. So the question is, if you believe that, under that impression, then why do you think we're the statistical outlier of historical precedents, going all the way back to 1953? And that's a question you have to ask yourself and answer yourself. And now if you also look at this chart, it does confirm, because then you have to ask, why is the time frame 6 and 12 months? Because from a trading perspective, more often than not, within the first 6 months, if you consistently bet the same amount, you would do better betting on stocks going up and then cutting your position after, say, 150 days versus waiting 150 days and cutting the losses. You would do better. So from a tactical standpoint, a swing trader, multi-quarter trader perspective, you would actually do well. And that's worth knowing. But if you've either fooled yourself into thinking you're a longer term investor, or you are a longer term investor, then this should concern you. And for one reason, maybe you don't chase after, because whenever they pause, it's probably going to spike up, a few percent run for the week, so on and so forth. Everybody gets exuberant and excited and so on and so forth. But, here we are. In 1990, it was, let's call it 425 days after the cut that the market actually saw its bottom. 425 days. That's a year and a few months. And then a lot of these are 250 days, 300 days, 350 days. That's an entire trading year almost. And that's worth taking into consideration, factoring in, and then adjusting and adapting to whatever your long-term plans are and conducting yourself in a fashion that's conducive with that. And this is just information you need to know. And you also see on the left-hand side, say you think, hey, I think the Fed's going to pause in the upcoming 6 months. Say you think that the terminal rate's going to be 6, and we're at 5 right now, and you think that they're going to do 25 basis points once a month for the next 4 months. So that's 120 days. If you look at this chart and you go back 120 days, what do the markets do? And a lot of them are actually going down. But if you thought back at 4% that the terminal rate was going to be 6%, and say you thought that 300 days, giving you enough time, you would see that it might be advantageous to actually buy into the stock market. Because the market going back 500 days, so that's a year plus, is up more often than not by the time that they get to their terminal rate and pause. So that's also a tactical trade and worth factoring in and considering and thinking about. But I see a lot of exuberance going on about how the pause means that the stock's rocket ship emoji, which they might in the short term, but that doesn't mean that they won't come back down to when to the price target of when the Fed had paused. Which is to say that the Fed pause, you buy, in the case of 1990, 425 days later, you've made no gains. And now maybe your stop loss is where you initially entered your position and you cut it and then the market goes up and then now you're chasing. It's all worth considering. Another thing TXMC Trades noted was this market is also the soonest time between rate hikes beginning and manufacturing PMIs contracting below 50, 230 days, beating the Volcker era record by 3 weeks. The Fed is hiking rates into an already slowing economy and trailing virtually every historical benchmark. Here in 2022, in 2022, 230 days. The closest ones are 349, 398 days. And then, I kept on picking on 1990. That was one of those days. And so if you think soft landing, 1990 was soft landing, we're still in the PMI contraction window of rates hike beginning and the PMI rolling over, then that's also similar. So then maybe we're a 1990 style, or you can go to the 1940s, or you could say the 1970s stagflation, whatever your predisposition is. But if arbitrarily we're going with the 1990 example, you could say we're similar. Okay, well that means you think the terminal rate's 6%. It's May now. It's April now. So May, June, July, August. So then August plus 400 days. So that's August of next year, plus a couple more months. So September, October. So we're talking that the bottom actually might not be till September or October. Just imagine this: if you were in 1990 and you were doing all of this, you predicted the terminal rate, you predicted the increments in which they would increase, and you got all of that right. You caught the Fed pause perfect. And here we are today. That means that the market won't bottom until September or October of 2024. Like, just think about that. If October 13th actually marked a low, it would be the closest market floor to a yield curve inversion, 3-month and 10-year, ever. So, yet again, are we a statistical anomaly this time, or is there something else to it? Because the market bottomed 12 days before the 3-month and 10-year inverted. The closest we've gotten historically is 315 days after the fact. And then going back to the 1990 example, 349 days. So that's worth thinking about. The stock market historically bottoms several months after an official recession begins. Now, of course, these are cherry-picked to demonstrate the point of the market not bottoming for several months after an official recession. And by the way, you won't know that until hindsight, because NBER is backwards looking. They're lagging, so you won't know till after the fact. So it doesn't necessarily help you, but it does know if you think a recession is coming, then that means the NBER is going to call whatever quarter you're thinking a recession is coming as a recession, which means that until months past that, the bottom won't occur. And it's nice to look at different charts demonstrating the same information differently, because that one chart, that messy chart I showed you, showed this too, but with other information involved with it. So it's nice to isolate things and visually see it in an infographic type fashion. And as a final note to all of this, it's also worth remembering that this is the quickest pace of a tightening cycle since 1988, and is historically, beyond 1988, one of the fastest tightening cycles. And then in recent times, which, due to institutional memory and people quitting, getting different jobs, institutional memory relapses about once a decade, and therefore 1988's irrelevant to them, even though it's quite relevant, because it sets a historical precedent and gives you a data set to extrapolate from, so it's all relevant. The lessons learned are relevant, but that's a different story for a different time, how people conduct themselves. And if we look to 1988, where I keep going on about this 1990 recession, 1991 period, that was also, well, that would be the second quickest cycle. Now, it didn't go as far as other cycles did, but it still was a quick one. So with that said, here's a review of last week's performance. Practically everything ended up Friday higher than it started off Monday. I added a new position, LPX, Louisiana Pacific. I've been biting at the bit, probably getting in too early on it. I would say so. There's really no margin of safety. I can't say I'd recommend anyone else to do it, but I've just been chomping at the bit on this thing forever, and it's in this wide consolidation pattern, and this is closer to the base, and it seems, I don't know, a decent entry point. It's definitely not a rock bottom price. It's not a depressed asset. It's not miserable pricing. Like I said, there's not really any margin of safety. See what happens. If it goes lower, I was initially going to initiate positions in Louisiana Pacific, possibly Boise Cascade, Blue Links. Builder's First Source, I believe, is breaking out here recently. It made an all-time high. And what they are is, I touched on Builder's First Source a month or two ago, talking about risk in the markets and how it's actually outperformed the S&P over the last decade. But people call it cyclical because it is a cyclical business. And what they are is they're manufacturers and distributors of building products for both commercial and residential and retail use, like OSB, Louisiana Pacific, like, I don't know, 50% of it is OSB, which is oriented strand board, and then they're growing the siding segment, and they have a South American segment, I believe in Chile and Brazil, and that's like 10% of the business. And anyway, the industry has been consolidating for a decade plus now and buying up competitors and becoming an oligopoly. And like I said, I was chomping at the bit, and it really is hard to sit on your hands sometimes. And I'm trying to build up I am building up my cash reserves, both in total dollar amount as well as percentage of portfolio. And so I kind of went against myself by buying Louisiana Pacific. But like I said, it's at like a 4 or 5 times trailing PE. Now, the forward PE is estimated in like 20, 25, but the analysts get this horribly wrong, and people's bearish on the market. Anyway, Blue Links is even worse. It's trading at pretty much price to book. Anyway, that's enough on that. Uranium's still trading like a dog, even though, like I said, it traded higher by Friday than Monday. Transocean is, Transocean ran hard, and Transocean has gone nowhere practically nowhere in the last 2.5 months. It ran hard at the beginning of the year and has pretty much bounced around in a 20, 25, 30% volatility range for the last 2 to 3 months. Tidewater is slow and steady, but it's also been bouncing around. And Kinross Gold is my largest percentage gain of a position, up 26%. And I didn't foresee the banking crisis, right? And my position in Kinross is smaller than I wanted it to be, and I actually had to chase a little bit to size up because I thought I was going to have, a lot more time than I did to get into it. And I was actually going to size it up decently, and so much for that. I'm not chasing, and it is what it is. But that's that on my portfolio. And with that said, thank you for watching, and until next time.